Most people buy real estate the hard way. They spend years accumulating wage savings, scrape together a down payment, and sign their name on a 30-year mortgage. Sophisticated investors take a completely different path. When a mortgage is tied to your Social Security number, the debt attaches to your personal identity. That single string of 9 digits links your rental property to everything else you own. If the market crashes or a tenant sues, your primary home, your savings, and your retirement accounts are all legally exposed. Even with a perfect track record, traditional banks utilize debt-to-income ratios that create a mathematical ceiling. Every new personal mortgage increases your debt load until the bank stops lending, usually capping a portfolio at just 2 or 3 properties. To bypass this limit, professional investors utilize corporate decoupling, establishing a business credit architecture that removes the individual's name from the debt entirely. Executing this requires meeting 2 distinct financial requirements. You need 20% liquid cash for a down payment and an 80% mortgage, all without accessing personal savings or leveraging a W-2. Acquiring property without personal risk is a structural problem of clearing those 2 hurdles using only the resources of a business entity. This process begins with the creation of a distinct financial person. First, legally form an LLC, secure an EIN from the IRS, and open business bank accounts. By establishing net 30 vendor accounts, the business builds its own Paydex credit score, completely separate from the owner. Once established, the focus moves to the 20% liquid down payment. This is handled through a strategy known as credit stacking. Stacking applies for multiple business cards within minutes. A reporting lag hides inquiries, yielding 0% approvals that form a capital pool. You cannot swipe cards at a title company, so liquidation bypasses this. Third-party platforms charge the cards, then wire funds directly to closing. By combining stacking and liquidation, the investor generates the full 20% down payment using unsecured, interest-free corporate cash. The second requirement is the remaining 80% mortgage, without submitting tax returns or personal income verification. This is achieved through a debt service coverage ratio, or DSCR loan. Unlike a traditional mortgage, DSCR underwriting is based on the cash flow of the property rather than the personal finances of the borrower. To qualify, the bank calculates the ratio between gross rent and total monthly obligations. If a property earns $3,000 against a $2,200 mortgage, the ratio is 1.36. Any ratio above 1.0 indicates the property covers its own debt. Because the asset meets this threshold, the bank issues the mortgage directly to the LLC. The human owner's personal credit limits and debt ratios are never part of the evaluation. With the DSCR loan secured, the property purchase is fully underwritten to the business entity. After the acquisition, the property enters a value-add phase. It is renovated, and a tenant is placed to solidify the property's rental income. At this stage, the investor must address the temporary debt. The down payment was funded by 0% credit cards, which only remain interest-free for a limited time. To exit this debt, the investor performs a cash-out refinance. Because the property has been renovated and its value has appreciated, the lender issues a new, larger DSCR loan. The excess funds are used to permanently pay off the stacked business credit cards. The resulting structure is a stabilized, cash-flowing property. The investor has 0 personal dollars invested in the deal and 0 personal debt tied to their Social Security number. Building a massive real estate portfolio is an exercise in corporate financial architecture. It relies on entity separation and the mathematical merit of the asset, rather than the limitations of an individual's personal paycheck.